Welcome to Yahoo Finance Live. It's Friday, January 20th. I'm Shauna Smith along with Dave Briggs. Let's get you up to speed on this afternoon's market action as we get ready to cap off the trading week. We're looking at the Dow with gains of 238 points. S&P also moving to the upside, up just about 1.5%. Let's take a look at the Nasdaq. The Nasdaq 100 up just about 2.5% today. A lot of that has to do with the gains that we're seeing from Netflix following their much better than expected subscriber growth number that we got out after the bell yesterday. And then also Google stock moving to the upside following some cost cutting measures, including a significant headcount reduction. That, of course, is driving Alphabet stock here. And that's why we're looking at the Nasdaq, the outperformer of the three major averages. Now, on a weekly basis, though, we are looking at a bit of a different picture. Taking a look at the 4-day chart, Nasdaq 100 barely positive, but taking a look at the S&P, you're looking at losses of just about 1%. The Dow losses of nearly 3%. And putting that in context here for weekly performance, the Dow on track for the worst week that we have seen since September. Taking a look at the sector action today, I mentioned the outperformance in the Nasdaq and in tech. You're looking at the tech sector up well over 2%, as well as communication services, followed by consumer discretionary. All three of those sectors up over 2%. All 11 of the S&P sectors in the green for the day. Utilities, the underperformer of the group, is still in positive territory. Looking at a 5-day move here, actually a 4-day because of holiday shortened week. A mixed picture, though, as we wrap up the week. Communication services is still in the green, pretty solid, up just over 1%. But industrials, the worst performing group of the week, as well as utilities there. So, Dave, we are looking at gains today, but on a weekly basis, though, losses for the three major averages.
And a weekly situation where the Fed kind of reiterated everything that they've been saying over and over again. We're going to get rates above 5%. We're going to hold there. You think through the rest of the year?
I think that is what they want investors to think. That's clearly been the message here to the markets over the last several months.
But they don't agree.
Seem to be changing their tune. I'm right. They don't agree. The market's looking for any sort of hope that maybe the Fed will back off those rate hikes, maybe potentially cut. But I certainly think it's a safe bet saying that they are going to keep rates higher for the rest of the year.
I think through 23 as well. All right. Thank you, Shauna. Let's get you up to speed now on the housing market. More gloomy numbers out today showing a beaten down sector. Existing home sales falling to their lowest level since 2014. Sales of previously owned homes falling 17.8% last year to 5 million. That's according to the National Association of Realtors. Sales were down 1.5% on a month-to-month basis. December sales down 34% from the prior year. This is now the 11th straight month of declines. NAR Chief Economist Lawrence Yun says he's, quote, hopeful that the worst in home sales is probably come to an end. Let's hope that that is the case. Remember, a lot of these numbers we see in housing are really lagging. Still a couple of more Fed increases to come. I don't think we're through it yet. I think Lawrence Yun is optimistic there. Still a little more to come. What do you think?
Yeah, exactly. I think it's going to take a little bit more just in terms of the drop in mortgage rates to get even more buyers off the sidelines. When you take a look at these numbers, when it comes to existing housing, sales dropping in the Northeast, in the South, and in the Midwest. It was unchanged in the West. So I guess when you just take a look at this data, the West seems to be doing okay, or at least showing some signs of stabilizing. Median house price increasing at the slowest pace since early in the pandemic. More sellers offering discounts, which I guess you could say might be a little bit of a piece of good news if you're a buyer, at least. But I don't know. I think it's certainly going to be a rough couple of months as the Fed does remain very hawkish and does seem committed to raising rates even further.
But that median home price you mentioned is the highest ever on record, $386,300.
But the growth is slowing.
Mixed bag.
I know. I'm trying to look at an optimistic viewpoint of this. All right, let's take a look at up to speed with Goldman Sachs, the worst performer in the Dow today. You're looking at losses of just over 2%. On Wall Street Journal report that the Fed is investigating Goldman's consumer business to determine whether it had proper oversight and safeguards in place as it ramped up lending. Now, the probe is also looking into instances of customer harm and whether the issues were properly handled. Goldman disclosed last summer that it is cooperating with a Consumer Financial Protection Bureau probe of its credit card business here. So again, shares under pressure off just over 2%, the worst performer in the Dow today, and really adding to some of the headaches that we have seen from Goldman recently. They announced job cuts earlier this month, so certainly some pressure on the stock today. We're looking at two-day losses of nearly 2%. Let's talk more about the broader market's moves and what we've seen played out this week and what this signals going forward. We want to bring in Ryan Dietrich. He's Carson Group Chief Market Economist. Ryan, it's great to see you here. So big banks kicked off earnings season last Friday. Here we are a week later. What do you make of the results that we've gotten so far and what that signals for what's ahead?
Yeah, thanks for having me back, guys. I mean, yes, the banks dropped, remember, for that last Friday, then came back. Overall, earnings have been kind of lackluster at best. Let's be honest, though. Most of the big boys do start, next week, so we get some of the real big names. But I want to dive in on something. You guys are talking about housing data. Yes, the housing data has just been, terrible, maybe is the best way to put it. But look at housing stocks. Housing stocks are up today. Housing stocks are leading, right? The market is a leading indicator. We're not saying if you're selling your house, buying a house, that might be messy. But the stock market is leading, and that's strength from consumer discretionary and housing. Those are things we didn't see last year, right? Let's be very clear. We didn't see that last year. So now we're seeing that. That is definitely something investors need to pay attention to.
That's something you bet would continue, though, Ryan?
Yeah, we would. We just released actually our 2023 outlook just this week. And one of our calls that you could say is more controversial, I guess, we don't see a recession this year. And I know, a lot of economists do, but we see some potential bottoming in the housing market. We see yields rolling over. We see huge spikes in people that are getting mortgages over the last week. The consumer, yes, it's not perfect, but the consumer, in our opinion, is still fairly strong. They still have that cushion of over $1 trillion of excess savings. And we think we can avoid a recession. And when you look what the stock market's doing here with the strength from all these different, look at tech, right? Tech did terrible last year. Now we're seeing leadership from there. It's a broad-based rally. To us, again, that's a different sign than we were seeing 12 months ago. And that's a positive thing.
Ryan, we really are coming off the worst year that we've seen for the market since 2008. I know you've done some historical data in terms of performance, how stocks tend to bounce back from bad years. What does that look like in terms of the performance that maybe we could expect here?
Yeah, good news is it's very rare, guys, to have two down years in a row, 73, 74, and then 3 years of the tech bubble. Those are also recessions. Again, we don't see a recession. If we have one, it's probably pretty minor with the consumer in pretty good shape going into it, not our base case. But bottom line is, stocks tend to bounce back. When you actually look at the worst 4 drops ever, guys, back in World War II, the following year was up every time, up like 27% on average. When you're just down for the year, you're up about 15% on average that next year, higher 80% of the time. So these are all just percentages of numbers, yes. But the key concept, again, it wasn't just bad for stocks, right? It was historically bad for bonds. A 60-40 portfolio, you had a really rough year. Now we've seen bonds actually coming back nicely and stocks, and we think it's going to be more of a back to normal. We think stocks, guys, can gain between 12 and 15% this year, with bonds giving you about 4 to 5%, kind of right about where the yields are. But we think, it's going to be a much better year than people give it credit for.
Digging your optimism, man. Tech layoffs, are those going to continue, and will they spread beyond the sector?
Yeah, we think they very well, great question. We think they very well could continue. If you look at overall tech layoffs, it's still such a small part of the overall economy. And the other parts of the economy are still growing. So that's where it's so unique. We all know tech had that huge run in 2020, 21, where they hired. Now they're cutting some of the excess fat, I guess you could say. Don't like to see it, right? But at the same time, we don't think it's going to spread to the rest of the economy. I mean, look at what some of the, who was it? United Airlines said, right? I mean, people are still flying. People are still going out. They're still eating nice restaurants. It's just different areas that are slowing down, and clearly tech is. But that's kind of the economy. We still think it's going to grow this year.
Ryan, you mentioned the outperformance that we are certainly seeing in tech. When you take a look at today's market moves, what do you think is going to lead us higher in terms of the growth versus the value debate?
Yep. Yeah, we're sticking with value. I know growth has had a good run all of a sudden, guys. Value outperformed growth by about 21% last year. The last time it did something like that was in 2000. Here's what matters. The next 6 years, value continued to outperform. Just because you had one big year of outperformance, that doesn't mean it has to end. And we like I talked about, the cyclical value areas. We like small caps, we like industrials, your financials, materials are starting to do better with some of those base metals. So if the economy avoids a recession, we think those are the areas you want to be in. We're neutral, market weight is what I should say, technology in general, but we like value and cyclical value and small caps here for 2023.
All right, I want to see how truly optimistic you are. Cincinnati Bengals, 5.5 point underdog against the Bills. Can they win this week? Can they win it all?
Yeah, I would not want to bet against Joe Burrow. I mean, it's awesome, the Bills and the story, and DeMar's doing a lot better. But I am a Bengals fan. I have to say, Houday, and betting against Joe Burrow is something historically hadn't done very well. So I like our chances this Sunday. I guess at 3:00 Eastern. We're very excited.
It's a tough matchup, man. In Buffalo, the sentimental favorite, Josh Allen. We'll talk off air about a little wager. All right, Ryan Dietrich. Have a good weekend. Good to see you, man.
Thanks, guys.
All right, we are just getting started here on Yahoo Finance Live. Coming up, Google joins a list of major tech companies laying off workers. We'll discuss what lies ahead for that battered sector. Then our coverage of the World Economic Forum continues. We'll hear from Vista Equity Partners founder, CEO Robert Smith. And avoiding burnout at work. A new survey shows a 4-day work week is raising productivity in the workplace. We'll debate that. Stay with us. We hired for a different economic reality than the one we face today. That's what Google CEO Sundar Pichai said today as parent company Alphabet announced it's laying off 12,000 employees. So what economic reality lies ahead for Google? John Freeman is the CFRA Vice President of Equity Research. Nice to see you, sir. It's nice to see in your notes, not entirely focused on the share bounce or the head count, but the personal side of this, if you don't mind weighing in there.
Yeah, getting laid off is just, it can be a traumatic experience for your life. I've been laid off. It is not fun. It's a 1-2 punch. One, it hits your ego, right? And then two, suddenly you have the stress of having to find a job all of a sudden. Now, with the likes of Google and the likes of Alphabet, Microsoft, right? We know what their their cost of their layoffs are going to be about 10,000 people, and that's 1.2 billion. They said they were taking on a charge. So back envelope, some of that might be restructuring, but a lot of that is severance, and that's that's close to $100,000, $120,000, somewhere around there for severance on average. I don't know if all the employees are getting that. That'd be something I'd like to know, because here's the thing: it's also it's not just the humane thing to do, and they can do it, but it's also their vested interest, because they're going to have to hire again. Right. And the coder community and all of the professionals around developing, securing and operating software, that's a tight community. Right. And they judge. Right. And so, treating the people who are laid off, well, I think bodes well for future ability to hire. I think that's a strategic move that they should be able to make. That's kind of the way I look at it.
John, taking a look at the reaction that we've seen in the stock today, shares up just about over 5% right now. When we talk about the significance of the cuts when it comes to Google's business, I guess, how significantly do you see this potentially helping Google's earnings in this very, very tough environment?
Right. So now I take off my human hat and I put on my equity analyst hat. And, in that regard, it always, I get pulled in one direction because I feel for the people. Then I'm also like, might be some pretty interesting expression of operating leverage there. Maybe margins go up, right? So, and that does happen, particularly in these. Not all software companies are the same. Not all software businesses are the same. I think the ones with more recurring revenue, and Google's advertising is not necessarily recurring, but you can pretty much count on it. It's not going to go into like free fall, right? Anytime soon, except maybe with ChatGPT, right? So, but you can, if you look at Microsoft, you look at Salesforce.com, you look at ServiceNow, you look at these enterprise software companies that are all cloud-based, their revenue is their software is mission critical, and the revenue is recurring, pretty, you count on it, may not grow as fast, right? But now your marginal cost really starts to fall off, and the operating margins are going to pop. And I think that's going to be the thing that surprises people about these companies and these stocks in the next couple of quarters, is that growth might, really decline faster than people expect, but earnings growth, revenue growth will decline faster than people expect, but earnings growth, right, profitability can definitely make up for it because of the inherent operating leverage of these cloud-based businesses.
You mentioned ChatGPT. That's the word that triggers me right now. All in on ChatGPT. Interesting reporting in the New York Times today. I'm sure you've seen it. Sergey Brin and Larry Page have come back to kind of answer this competition from Microsoft, who is out of the gate leading this field. How significant is that gap? Can they catch up? And how big of a differentiator is it in the sector? See, there is a gap. But there's definitely a gap, but I don't think it's that particularly great. It's not something. I mean, Alphabet's been working on this stuff also for a long time. Microsoft with ChatGPT simply has a kind of a surge of usefulness, which begets a surge of usage, which begets a surge of usefulness. These are feedback loops, right? I don't think Google's going to sit still on this. But here's the thing: ChatGPT's threat to Google search, I think, is much less. It's probably a bigger deal or more overhyped. What I really see ChatGPT for is the integration with Office as an opportunity for Microsoft. That's tremendous, right? That's what really I think it's interesting. If you have an assistant, think about it as a word companion. I mean, there's so many different places you could see it being incredibly useful as people get to use it, and it is a tool that people will need to have to get to use and become proficient with, and the proficiency of the software and the proficiency of the users. Again, it's a feedback loop. So I see a lot of potential with ChatGPT. I don't think Google's out of the race, but I think they're in a slightly different race. I think the things that they are focused on are not quite what Microsoft is focused on. It's with the big overlap, obviously, being search, and to the degree that Microsoft could use ChatGPT to take search, well, that's just good for them, right? They've obviously got a very small percentage of share now. So it's all upside for Microsoft as the way I see it.
John, in terms of the upside there, then for Microsoft, it's very popular. You can clearly see that by the number of times it's been used, by the downloads, also just the number of headlines that it has grabbed over the last month and a half. How does Microsoft, though, monetize it when we talk about it really potentially having an impact down the line?
Well, that's a difficult thing to say right now. And I don't think the monetization, I think they'll probably wait on pressing the pedal on monetization. And what they want to do is demonstrate value and get people to use it. So it'll be integrated with Microsoft Word. It'll be integrated with all your Office apps. And for a while, you'll start to use it. And then, it's the most brute force sort of way of expressing the monetization is just they'll raise prices and have, a chat GTP optimized version of Office, right? So I think that's one way of doing it. But clearly they have to demonstrate value. And obviously, right off the bat, they're seemingly demonstrating some pretty tremendous value. The interesting thing about the Pichai comment about a code red, I thought was interesting because it reminded me a lot of Bill Gates's, email in 1995. I'm old enough to remember that. And, when he was, basically trying to goad Microsoft into reacting to Netscape and the threat of the World Wide Web and the threat of the browser. It seems very similar. History doesn't repeat, but it certainly rhymes.
All right, John Friedman, we got to leave it there. CFRA, thanks so much for joining us.
Thank you so much.
All right, we just talked about Google. While that is far from the only company here cutting jobs, online furniture retailer Wayfair laying off over 1,700 workers, 10% of its workforce. Vox Media announcing in a memo to staff that it will cut 7% of its workforce. That's according to multiple reports. More than 54,000 tech jobs have been lost in January alone, according to layoffs.FYI, which has been tracking data going back to the start of the pandemic. Google, Meta, and Microsoft have laid off the most employees, according to the tracker. However, these same companies went on a hiring spree during the pandemic.
Yeah, Meta, the most glaring example. By the end of December 2019, the Zuckerberg-run company had nearly 45,000 employees, but by September of 22, that headcount nearly doubled to more than 87,000. Ultimately, the company slashed 13% of its workforce, 11,000 employees late last year, taking back some of those pandemic-era gains. The same can be said for the other tech giants. Amazon's numbers also nearly doubled. Since Q1 2020, the company just recently cutting 18,000 jobs. You can see Google and Microsoft's headcounts each grew by over 50% during the pandemic, and now both have laid off around 22,000 employees total. Apple, the only tech giant on this graph yet to announce layoffs, and that remains the big question here, Shauna. It feels like the earth has been softened to the point where I don't think we'd be as shocked if Apple does join the parade of tech giants to do some layoffs, but Tim Cook has not signaled that yet, so don't panic. I just want to say personally, what John Freeman said there really resonates, and I hope some of you tech workers who are laid off take what he said to heart, because it is difficult. It is gut-wrenching. I've been laid off a couple of times, including right before the pandemic, when it was impossible to find a job. Frankly, personally, I was a ball of tears. I was depressed, and now I realize it was the best thing that ever happened to me, and it will be for you as well someday. It will be a difficult environment to find a job because there are more tech layoffs to come. We still, though, have a very tight labor market. I know it's something you haven't been through. It is deeply personal to me. Sorry to go on and on and on here, but I think having that adversity in your life, which most of this generation hasn't had yet, they will look back on years from now as a very good thing and built their intestinal fortitude. Look at how many businesses have been started since middle of the pandemic. It's caused a real wave of entrepreneurs to begin.
It certainly has, and it's really, when you're presented with something like this, obviously it's news that nobody wants to hear. You're not hoping that you are part of the layoffs, but it is a real opportunity. You mentioned the number of jobs that have been started since the pandemic. It is an opportunity for people to take a second and reflect. And when we take into account what some of these tech giants are doing during these layoffs, yes, they're being forced to make tough decisions. They're being forced to lay off thousands of workers, many of them, including Google today, offering services, HR services, helping those that are laid off get their footing and hopefully find the next opportunity, which is so key in this environment, especially if you are part of this group that's getting laid off in big tech, because clearly it is something that the industry-wide, many of the larger companies are dealing with, are being forced to make this decision. So it is a tough environment if maybe you want to stay within that sector, but hopefully it will open up more opportunities for you down the road as you kind of open your horizons a little bit.
If you have Google, if you have Amazon, if you have Microsoft on your resume, build on that skill set just to try to personalize this a bit.
All right, well, coming up next, Vista Equity Partners founder and CEO Robert Smith. He will be joining us from Davos, Switzerland, to explain why he sees IT spending falling in 2023. We'll bring you that interview next. Our coverage of the World Economic Forum continues. Our very own Julie Hyman spoke with Vista Equity Partners founder and CEO Robert Smith on his key takeaways from the annual meeting. Let's take a listen.
People are excited to get back, talk, come up with solutions, plans. And frankly, we got a lot of work done during the COVID period remotely. Things that we're focused on in terms of digital and ensuring we have some digital enablement across the planet. One of our initiatives here is the Edison Alliance, looking to bring 1 billion people online. We're halfway to that goal, and it is we have 90 partners across the globe working on it, and we're quite excited about that sort of work. And there's nothing like getting together in the room to discuss where we are, what we've gotten done, and what efforts we're going to do in sharing best practices to accomplish our goals. So it's actually pretty exciting. And
at the same time, there are a lot of things to tackle around the globe, right? We had the surprise appearance of the Chinese and the sort of positive tone, right, from the Chinese. We have, of course, the Russia war with Ukraine, that continuing, a lot of discussion about that. What are your takeaways? Let's start with China, right, and about growth there, and about that more maybe conciliatory tone.
Yeah, I would would characterize it as an openness to engage. You know, China and America, I think, both have realized that we do need to have trade. Now, there's going to be areas where we're going to determine that, okay, we're not going to, share information, those sort of things, and that's fine, and we'll create those sort of topics. But it's important that each of those economies engage in meaningful ways. And I think what happened is we spent years, I call it, in our own echo chambers. We were in our echo chamber, they were in theirs. You know, media, of course, was feeding us whatever media likes to feed us. But now that we've gotten back together and starting to get back together, and China has opened up, and I think Hong Kong is going to play a critical role in the engagement of the U.S. and China, I actually feel very optimistic that we will actually help each other's economies grow. They have a 500 million person emerging class, and we actually need that market to sell our products into. And I think it's going to be an important one for us to ensure that we create the right sort of engagement dynamic in fair trading and paradigm. And I think it's going to benefit the U.S. population and Europe as well.
When it comes to Russia, Ukraine, and of course I see you're wearing a Ukrainian pen, the business community has been very vocal and very active on this front. Why is it important from a business perspective, not just a sort of humanitarian, democratic perspective?
Sure, it is critical that that war end. And it has to end in a way that we can get the food, the fertilizer, moving back to the economies that rely on the Ukrainian grain and that rely on the fertilizer so that we can feed the population. One of the worst humanitarian crises that could occur is if we aren't able to feed all the 90 plus nations that the Ukrainian grain feeds, and then you'll start to see a mass migration if people aren't being fed. And I'll say we're lucky in some respects. The winter hasn't been so severe in Europe, but this war needs to end, and it needs to end now. We have, of course, tremendous respect for the way that the Ukrainian people are fighting. But the rest of the world, even those who are sitting on the sidelines, now have to take a position and say this needs to end. We have enough to deal with on this planet to have to deal with the ground war. It's just the wrong answer.
One of the other areas where you're very active is racial equity and inclusion. And when I look around this conference, I still do not see that many people of color represented. There is still a dynamic with women and men where women are underrepresented. What work do you think the World Economic Forum needs to do on this?
Yeah, so we are doing a lot of work, and I will say we're making progress. It's not as fast. I was in a conference yesterday, and we talked about of the $126 trillion in assets, less than 1.4% are managed by women and people of color. So the asset allocators, they need to do very simple things like allocate more assets to the money managers who are women and people of color. So that's kind of point one. Point two, the asset managers have to ensure that we are building sustainable pipelines for employees and for our stakeholders that are more diverse. I mean, Vista, I think is a gender parity firm. We have over 37% of our population are people of color. But you have to build pipelines in order for that to be sustainable. And so one of the things we do here is share best practices. Share the ways that companies who have been successful are able to create pipeline, develop talent, ensure that that talent is successful in their roles, and ensuring that we also put infrastructure in place so that talent can actually give back to its communities in an effective way. So again, part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action. So that's why I'm excited to be here. And frankly, that's my main mission here, is ensure that we can bring more resources to communities that I care about so they can become more broadband enabled and economically enabled, because that's what's going to create the stability that we will all benefit from.
I can't let you be here without talking about tech spending, right?
Oh, great, sure.
We talked about it in the fall, and it sounded like it was mostly holding up well, particularly in certain areas.
Right.
And your expertise is really in enterprise software specifically. Has that changed at all? I mean, we just heard Microsoft is laying off 10,000 people. Obviously, there have been a lot of layoffs in the sector. Talk to me about that.
A lot of tech companies, of course, we came out of a period in the pandemic where we had a massive migration to work from home, work remotely, all those sort of things. So people were buying and expanding their organizations in advance of that sort of growth. Of course, that wasn't sustainable. So we're at a point now where there's a ratcheting down as people have come back to work, some slowdown in certain parts of the economy, consumer principally, not necessarily enterprise. And so you're going to see these companies start to ratchet down what was their forward planning. It's probably second quarter, third quarter, we'll see that come to a new equilibrium of their expense base. Here's what we've seen in our enterprise market. We've seen Q1 actually have a highest spending ever in the history of enterprise software. Q1 last year. Q2, we saw a drop down. Q3, a drop down. And guess what? Q4, it bumped up again. The productivity software which has enabled businesses to do more with less, with fewer, and actually expand their markets, maintain their margins, is going to be one of the principal areas of growth probably for 2023 when we reach the new equilibrium, and hopefully as China comes back online, hopefully as we end the war in the Ukraine, we'll see a revised pattern of consumption that can hopefully drive us all to a better economic outcome.
That was Vista Equity Partners founder and CEO Robert Smith. Well, coming up, shares of Wayfair surging higher today, now up just over 21%, hitting the highest level we've seen in about 4 months. We got more on that when we come back. It's time for our triple play. 3 stocks that we're watching in the final 30 minutes of trading. We've got Wayfair, Nordstrom, and Eli Lilly. My pick is Wayfair. Shares jumping today after the company announced plans to cut about 10% of its overall workforce. That equates to more than 1,700 jobs. It includes 1,200 corporate jobs as it looks to, quote, eliminate management layers and reorganize to be more agile. Now, the stock up well over 20% today. That's the highest level we've seen in just about 4 months. Truist writing in a note today that the move, quote, makes sense and will help margins. Wells Fargo raised its price target on the stock, raising it to $35 from $30, saying that it is a sign that Wayfair is taking its positive EBITDA and free cash flow break-even goals more seriously. Now, the move here coming as Wayfair's business has been under pressure in recent quarters. Sales have declined for more than a year. Putting that in perspective of the impact that's had on the stock, shares are off about 75% over the past 12 months here. So, Josh, when you take into account their performance, obviously some changes needed to be made. Wayfair, one of many companies that have been forced to cut costs here in recent quarters. We'll see how that impacts the business in the coming quarters.
Wayfair, one of those pandemic darlings that we talk about all the time, right? That saw a big boom during the pandemic because of what the business was and sort of how people were ordering at the time. But interesting because it is a little bit different of a story than, say, a Peloton or even some of the tech names we talk about when we talk about headcount. When you go back to Q3 of 2019, Wayfair was employing, they said, more than 16,000 people. That was right before the pandemic started, of course. Last quarter, they just told us they were employing approximately 17,000 people. That's not that big of a difference in headcount. To now cut 1,700 people, they actually, give or take, could be either even with where they were before the pandemic or employing even less people. So sort of an interesting, different move than what we've seen from other companies there. But my play today, guys, is Nordstrom. This was a stock that was down about 7% after hours yesterday when news first broke of the company's disappointing holiday season. Net sales fell 3.5% in the 9 weeks ending December 31st. CEO Eric Nordstrom noting the holiday season was, quote, highly promotional and sales were softer than pre-pandemic levels. The company lowered its full-year profit outlook from a high-end range of $2.60 down to $1.70, but Wall Street analysts might have helped the retailer repair some of these losses here. Morgan Stanley called the lower guidance, quote, unsurprising. Meanwhile, Jefferies called the promotional environment weighing on the stock temporary. And we've seen a lot of those retail names we talked about after hours yesterday, Dave, sort of come back up. Kohl's, Macy's, Ralph Lauren, all set to probably close the day higher today. So it seems like, well, we were a little worried about the holiday season. Maybe people didn't have that big of expectations for the holiday season either.
Probably right. What jumped out to me, though, about the Nordstrom number was net sales down about 1.7% at the signature brand Nordstrom, but Nordstrom Rack was down 7.6%. Dramatic spread there. And that's not really markdowns. Nordstrom Rack feeds an entirely different demographic, always markdowns. That's what the brand is. Was a little bit surprised by the difference there. Did that strike you as odd?
Well, it's not the trade down that we thought we were supposed to see, right? You would think Nordstrom Rack would hold up.
That's what my impression was, yeah.
You can normally get a good shoe deal at Nordstrom Rack, Dave. I love shopping the shoes over there.
I do too. I'm a fan, big fan. All right, my play is Eli Lilly. Shares of the drug maker sinking today as the FDA declined to grant accelerated approval to its experimental Alzheimer's drug donanemab. The FDA rejecting the application because it needed data from at least 100 patients taking that drug for at least 1 year. Now, Lilly says many had to stop taking the drug after 6 months due to the speed of the plaque reduction. So maybe worked too fast is what they're saying. The company plans to file phase 3 clinical trial data later this year for a traditional FDA approval. More than 6 million Americans are suffering with Alzheimer's today. Dr. Howard Fillett of the Alzheimer's Drug Discovery Foundation telling me, quote, amyloid-clearing drugs such as these are one part of the solution, but there remains a pressing need to develop a new generation of drugs targeting all aspects of the biology of aging. Shares of Lilly down about 1.5% today. They were far worse shape earlier in the day, down more than 3%. They have rallied as we've gotten closer to the close, still up more than 40% over the last 12 months. This has been a real area of focus for Big Pharma, needless to say, because of how difficult, how painful it is, and how many Americans suffer through it. It's been a controversial process given the FDA approval process and the extreme cost of these drugs.
Yeah, certainly. And there certainly has been a race here to try to find some sort of treatment in this space. When you take into account all of the drugs, all of the treatments that are under consideration, this is according to the Alzheimer's Association. This is just one of more than 300 treatments that are in clinical trials. So hopefully we will continue to get positive results. And it also seems like Eli Lilly still remains pretty upbeat in terms of what we could see at the future trials that we will get from this drug. Taking into account, though, what this could mean for some of the competitors out there. We know Biogen has an Alzheimer's treatment that William Blair was out with a note saying that it could actually be a positive here for that company, just an investment angle, putting aside the human angle here for a second. Just taking a look at Biogen, though, that stock actually ticking to the upside today on the heels of this news, but certainly more treatments are needed within Alzheimer's. And when you take into account all the clinical trials that are currently underway, hopefully we will start getting positive results, more positive results in the future.
It is such a painful process to watch as someone who has had to suffer through it. Let's hope this race is won soon. Josh Schaefer, thanks for playing. Coming up, with an uptick in layoffs and high inflation, our next guest tells us what investors should keep in mind before heading into retirement. That's next. Allspring's just released a retirement report that challenges what they call conventional wisdom. Here with insight on how to think outside the box about savings and even Social Security and Medicare is Nate Miles, Allspring Head of Retirement, for our Retirement Ready segment brought to you by Fidelity Investments. Nate, good to see you. Let's talk about just the environment in which we're in. Everyone talking about a potential recession, a potentially flat S&P, if not down 5-10%. How do you factor that in if you are anywhere near retirement?
I think the best way to do it is something that they hopefully would have done many years ago, and that's start saving early. You know, we think about the regrets that most of our survey respondents had. It was that they did not start saving early enough. The way that respondents or near retirees that we surveyed are looking to solve for this problem is really by working in retirement. 30% of people that are near retirement, so those are people that we expect to retire in the next 10 years, have considered working in retirement. But 25% of them have resigned to either working later and retiring at a later date and or just expecting less in retirement. So people are responding to it, I think, in really sensible ways. But the main regret from our study, I think, helps to create more resiliency and hopefully would help them to avoid some of that regret, many decades ago.
And within your survey here, you go through a number of common misconceptions. When we talk about preparing for retirement, one of the things that you dive into is savings targets. How strict do you need to be in terms of what your target is, and how do you identify that target?
Yeah, I think that the general rule of thumb is more is always better than less when it comes to saving, right? Because you're growing your pool of assets faster. You're also living off less. And that means when you hit retirement, there's less income that you were using for consumption initially. Generally speaking, anywhere above 10% is a great place to start, particularly if you start earlier. One of the things that concerned us about the survey actually was that people that didn't start saving until after 40 were only saving 50% of the time at about a 10% rate. And that was roughly equivalent to people who began saving in their 20s and 30s. And so even when people are saving later, they're not actually making up for kind of those 10 or 20 years in terms of that delayed start date.
And no matter where you are in this process, you're certainly concerned with Social Security and Medicare benefits. How do you factor that in?
Yeah, I think what's interesting is if you consider the employer-sponsored retirement world, for the better part of probably 2 decades, we've been trying to make things simpler. So doing things like auto-enrollment and auto-escalation and auto-deferral into things like target date funds. And that's really because for the majority of participants, they either lack the engagement or financial literacy to make, oftentimes the best decision for them. And so things like auto-enrollment, auto-escalation will help resolve some of those issues on their behalf. And we're seeing more and more plans add that. With the recent passing of Secure 2.0, we expect that even more participants in employer-sponsored plans will do that. What's interesting is that while conventional wisdom is that many early savers don't have the engagement or sophistication, as they move towards retirement, more than half of retirees and 56% of near retirees are self-educated on things like when to retire, how much income they're going to need, and the sources of income they're going to generate from retirement. So there's kind of a juxtaposition between what we expect and actually what near retirees and retirees are doing as they approach that time frame.
Nate, breaking it down even further by gender here, 31% of women are anxious about retirement versus 19% of men. So it looks like from this survey, women are a little bit more just concerned about the amount of money that they have saved up. What do they need to know, and really what they need to consider before retiring?
Yeah, and this is something that we've seen going back for many, many years. We've been doing this study at Allspring for 20 years now. And this is something that we see consistently. Generally, women are less confident in retirement and generally more anxious. Part of that is they oftentimes are not in the workforce for the entirety of their career. And so they're not benefiting from that time in savings. This is one area where, as I mentioned a moment ago, the autos will really help. Where we're going to get more and more women in the workforce actually saving for retirement for longer periods of time. The autos are a great equalizer as it pertains to both how long people are saving to the extent they're in the workforce and also the amount that they save over time. So that's certainly one thing that we've seen. The other thing that we see in the data as pertains to women is that they are more actively engaged. They tend to spend more time thinking about how much income they're going to need in retirement and oftentimes will more frequently talk with an advisor as they move towards that retirement phase more so than men do.
Certainly very important here. Nate Miles, Allspring Head of Retirement, for joining us. Thank you so much for Retirement Ready series brought to you by Fidelity Investments. All right, well, coming up, nearly 40 Regal Cinema movie theaters are closing. We'll tell you why next. "39 more Regal theaters across the United States are going to be closing their doors. Regal parent company Cineworld filing for bankruptcy in September. Now, in a recent court filing, Cineworld is saying that it will reject the leases at the 39 theater starting February 15th. The move will save the company about $22 million annually. All right, coming up, we are counting down to the closing bell on Wall Street, looking at gains across the board. Dow up 319. We'll be right back.
All right, we're just a couple of minutes away from the closing bell, so let's bring in Yahoo Finance's Jared Blickery to break down the market action. Jared, hello, my friend. What are we seeing?
Hello. Well, we'll get to the general markets in a second. Let's take a look at LI Financial first. Amid everything that's happened this week, they announced earnings this morning. And guess what? The stock is up by 20%. That is a record amount for any day. And this is after the company reported fourth quarter earnings that were better than the street expected. Now, revenues also came in ahead, but they're being offset modestly by worsening provisions for credit quality, all of which is catching the eye of analyst firm KBW. They're honing in on the 2023 outlook, where management provided metrics that were worse than their expectations, but better than the low bar analysts had planned for. So the analyst notes that the used car prices at this point are tracking management's expectations of weakness, and net interest margin is about in line with Wall Street expectations. Now, lots of negative sentiment is already priced into the stock, and KBW is expecting, quote, a relief rally. Let's take a look at that stock right here. And this is basically since inception here, going all the way back to about 2014. And you can see it's up a whopping 22%. So like a lot of other financial firms, especially some of the non-money center banks, they have had a little bit of trouble this week. And I'll show you that in a second. Now I want to hone in on the sector performance for the week. This is actually today. You can see the top three sectors there: XLC, XLK, XLY. Those are the mega cap sectors. And when you take a look at what's happened this week, not as pretty. Industrials down 3.5%, utilities down 3%, but communication services, that includes Alphabet and also Meta and also Netflix, that's in the news today, that is up 1.4% over the week, and then followed by energy and tech. Those are the only ones in the green. Want to show you something else here. I'm going to go to the indices now and show you what's happened for the week. Now, the Dow, unlike last year, most of last year, it was the outperformer. So far this year, it's the underperformer. Same this week. Now, the Dow is down just over 2.75% over the last 4 days. And now you compare that to the Nasdaq, which is leading today up 2.5%. Guess what? It is now positive for the week, and that is up 0.5%. Now, I want to show you something else. Here's the S&P 500. This kind of sets up what we might expect for next week. This is a one-year chart. We are consolidating very, very, very tightly, not only from the upside but also from the downside. So imminently, within the next week, probably sometime next week, we're going to have to break out. Whichever way we break, probably going to get a lot of momentum. Now, let's cycle through some of the heat maps on a weekly basis. That was a sector action. I'm going to go to the Nasdaq. Now, this is a 4-day performance here with about 30 seconds to go. We got Tesla up 9%, Alphabet up 6.5%, Apple 2.2%. And when we take a look at some of the leaders and sentiment indices, Bito, this is only over 4 days. Bitcoin, that ETF is up 14.5%, followed by meme stocks, software, ARK, internet, and also Korean stocks. To the downside, cannabis and regional banks. I did mention them before. Those are taking the biggest hit. Here's your closing bell, the final one of the week.
All right, well, with that ends the trading week. All three of the major averages in the green for today, at least. Dow closing up 329 points, S&P up nearly 2%. The Nasdaq, the outperformer of the three for today and also for the week. The Nasdaq closing up just over 2.5% today for the week. Now in positive territory for 3 weeks in a row. So 3 straight weeks of gains. Today's gains really being driven by the movement that we saw in Netflix and also in Google stock. Taking a look at S&P over the last week, that's in the red, closing off just about 0.7%. The Dow off about 2.7% for the week, a nearly 3% drop in the Dow for the week. All right, we want to dive a little bit deeper on some of the biggest stories, the biggest stock stories of the week also today. And let's start with Netflix. We're looking at gains of just about 8.5%. The move higher coming after the company reported quarterly subscriber growth, nearly double what the street had been expecting. Netflix's positive number there outshining the streaming giant shakeup in the C-suite. Co-founder Reed Hastings stepping away from his co-CEO role. It is important to point out, though, he is staying on as chairman, so he's not totally stepping aside here when it comes to Netflix. But Dave, taking a look at the reaction in the stock today, that subscriber number much bigger than I was anticipating. Shares hitting the highest level that we've seen since April. The stock has now more than doubled from the low back in May. Safe to say that its new ad tier seems to be working. And then, of course, that strong slate of content is paying off for now.
Yeah, literally every hit that you see in the streaming space has been Netflix this year, with the exception of really Yellowstone, and that's more of a traditional legacy media. But you look at Glass Onion has been huge, and Wednesday's been massive, and they just continue to roll them out. But I was really surprised by the reaction to Reed Hastings, because just about every analyst said one of the best CEOs in this country today. And yet they applauded the transition and how they handled it and seemed to be very optimistic about them not falling off one bit. So you thought with the applauds would be some more fears that Netflix might lose their way, but that was not the case.
No, it doesn't certainly seem to be the case. JP Morgan was out with a note saying that Reed's exit, it does mark the end of an era, clearly, but they're expecting a smooth transition. And Hastings saying in that blog post that they have been preparing for this. He's been preparing for it with the board for years. So it seems, at least for right now, Wall Street is pretty confident in the direction of the company. This is totally different reaction than what we've seen to Netflix's earnings recently. Evercore was out with a note saying that the new ad tier, the crackdown on password sharing, that those are major catalysts here, and they're very confident that it's going to drive a material reacceleration in revenue and EPS growth, something that the street has been waiting for when it comes to Netflix.
Really curious to ask a guest coming up here, the author of Binge Times, what it is about Netflix that might teach other companies in this space that co-CEOs work, because they are staying in that co-CEO lane. I do want to mention other streamers seem to gain off of Netflix as well. Warner Brothers Discovery up more than 4% and up 36% this year. Disney's up more than 4% and up 16% this year. And lastly, Paramount is up 4% today as well, all three of them, and up 19% this year. So yes, they were all beaten down names last year, but a lot of optimism in the streaming space right now. Not so much the case in tech, of course. Tech layoffs this week causing varying reaction to stocks. Microsoft laid off 10,000 workers and saw shares tumble roughly 3%. Meanwhile, Google's layoffs appear to have had the opposite impact, with the shares climbing today. And why that's, I think, really notable is that they're both making layoffs for exactly the same reason. They overhired during the pandemic, which demand was skyrocketing, and now they're simply cutting back because it's a different economy moving forward. Why do you think the stocks reacted so differently?
I think in Microsoft's regard, I think it was expected from the street, and maybe that's why we didn't really see the reaction. A lot of that had already been priced in. But I think Google's cuts really did surprise the street. When you take a look at the gains that we saw today, significant move to the upside. And when you take a look at some of the analyst commentary that we have gotten out so far, Morgan Stanley was out saying that they do expect these job cuts to save between $3 and $5 billion. They called them a welcome surprise. They say it speaks to Google's ability to really make difficult decisions on how to better manage cash flow. So I think many analysts weren't necessarily expecting Google to have to come out and slash 12,000 jobs. So I think that's why we're seeing such a bounce up in the stock today, given the cost cuts that the company will get from this.
Big picture, some wonder if this is a positive Fed story in terms of moving the unemployment rate up. We are still at a 50-year low of 3.5, and you got to consider, although these get a lot of headlines, these big tech firms, such a small slice of our employment. You're talking about 10% of the economy in terms of what they make up, but not in terms of the share of the employment in the United States, only about 2%. So really a small slice, not going to move the needle in terms of what Jerome Powell wants and needs to see. That's the heartless side of the story.
Yeah, certainly important to bring up, though. We also want to talk about some of the big banks, because Goldman Sachs, Morgan Stanley, both reported on Tuesday. Goldman reporting profits were down nearly 70% on a yearly basis in its most recent quarter. Shares, though, down another 2.5% today, falling on the news on a journal report that the Federal Reserve is investigating Goldman's consumer lending business. Of course, this adds to some of the woes facing Goldman right now. I mentioned that 70% drop in profit. Goldman also cutting over 3,000 jobs earlier this month. We know many of those jobs coming from his trading and investment banking division, something that Goldman is going to be relying on more so going forward when you take into account it's moving away from that consumer side of its business. But certainly this probe here from the Federal Reserve, what the Journal is reporting, another challenge facing the bank, Dave.
Yeah, and that consumer facing, the Marcus, as it's called, really has been the rough go, repeatedly struggling in that area. It'll be a sports reference here. Interesting how they make halftime adjustments, because now they're going to have to react to what others around them have done. They have led for so long. Now we're going to have to see, with deal making continually flatlining, how do they adjust to what others are doing? The only one of the big banks to make layoffs, David Solomon said, tried to do too much too quickly. Again, that was their largest quarterly miss in more than a decade. On the other hand, Morgan Stanley rising after exceeding earnings expectations this week. The company's wealth management business posted record net revenue of $6.3 billion. That was the difference maker. Wealth management, they pivoted. They perhaps saw the lack of M&A, the lack of deal making ahead, made a move, and it paid off big time. How will Goldman Sachs follow and react?
Yeah, certainly. UBS called their results, fourth quarter results, encouraging. And also what struck me from Morgan Stanley, comparing it to what we've heard from the other banks, was the comments from CEO James Gorman. He was pretty upbeat just in terms of saying that he is very positive with the outlook of Morgan Stanley right now, saying that a Fed pause will boost deal making and underwriting activity. Really seeing maybe a green light here at the end of this tunnel, some light at the end of the tunnel. But Morgan Stanley, clearly the outperformer, especially when you put it up against Goldman Sachs in terms of the numbers that they reported. But like you were saying, almost all of it had to do with the wealth management arm.
All right, and rounding things out with Tesla seeing positive action this week to its vehicle price cuts after the stock initially dropped on the news last Friday. Wall Street analysts out this week highlighting that while the move may hurt margins, Teslas are now more affordable and the company should see increased demand moving forward. Piper Sandler writing in a note to clients earlier this week, Tesla can now, quote, easily achieve at least 50% delivery growth in 2023. Now, these very same analysts were very critical of the move initially because of the impact on margins, and now they've really kind of flipped to applaud the move because it opens up a whole new audience to Teslas that can now afford the car. It'll be interesting to see. We won't get a look at it in next week's earnings because this is really a Q1 next quarter story. It will be really interesting to see how much those margins are trimmed.
Yeah, exactly. And I think that's a key issue here because, yes, they are more optimistic in terms of demand, in terms of Tesla being able to reach some of those delivery targets. But the pressure it's going to have on margins, I think that's still a huge question out there. When you take a look at some of the analyst action, we have seen a number of the price targets lowered on Tesla, at least for right now. It's Citi lowering their price target to 137 from 140. Piper Sandler, even though they were optimistic about those deliveries, they did mention the margin pressure here, at least in the short term. And the average price target on the street now is just around 192, so substantially higher from where we are today, but that's off more than 30% from the average price target just in November. So really putting that in perspective. And I think analysts still have some questions about that margin pressure and also what demand, even with the price cuts, might look like if we do get a deeper recession than maybe many are expecting today.
As for the price cuts in China, which preceded ours, initially we thought really adverse reaction, a lot of protest to Tesla factories from people that just bought a Tesla. Dan Ives and Wedbush, though, took a survey, and in China found nearly 70% responded these recent price cuts have positively influenced their decision to more likely purchase a Tesla Model Y. So it looks like a win in China. Let's stay with autos. GM says it will be investing nearly $1 billion in 4 U.S. facilities to manufacture V8 engines and EV parts. Yahoo Finance senior autos reporter Praz Subramanian has the details. Hey, Praz.
Hey, how's it going, man? So yeah, $1 billion into V8 production and also EV components. Like you said, 4 plants across Midwest and Western New York. Mostly, like you said, for those gas part for those engines. But with regards to EVs, GM ramping up their EV production here. We've known about this for a while. In this case, it's gonna be for casting parts and other components. This is on their way to GM making 1 million EVs annually by 2025. That's the goal anyway for Mary Barra and company.
So, Praz, when you take into account, yes, this is a step in the right direction. We spend a lot of times focused on EVs, but future investment down the line, what do you think that looks like, not only from GM, but also from some of the competitors out there?
Well, in this case, we're seeing them invest heavily into V8s, these gas-powered engines that we're seeing that they're still important for the automaker, right? Because they need these for the Tahoes, their Silverados, Escalades, and things like that. So it sounds like this is just sort of a way for GM to sort of bet on the next 10 years or so, because they don't, as they see 2035 as their kind of goal for pure electrics. That's still a long time from now, and they're going to be investing in gas-powered engines. And this is along the same lines as Ford kind of splitting the company up into two parts, their EV business and also their gas power business. That's also pretty big. And Stellantis and their CEO talking about how we don't see that gas business going away anytime soon, especially if we can make more fuel efficient engines and replace older cars with these cars that spew less carbon out the exhaust pipe and also give you better mileage, better performance, and also might be better for the environment too.
All right, Pras Rumanian there. Have a good weekend, my friend. Thank you. Coming up, a leadership shakeup at Netflix. Co-CEO Reed Hastings stepping down. Our next guest tells us about what might be next for the streaming giant. Stay with us. Shares of Netflix surging today, just about 8.5% on a stellar earnings report in which the streaming giant added more than 7 million subscribers. Up big time, more than twice that this year. The headline, however, remains CEO Reed Hastings stepping down as co-CEO. Joining us now is Don Chmielewski, Reuters U.S. entertainment business correspondent and co-author of Binge Times. Nice to see you. So let's talk about this Reed Hastings departure. Going to stay on as chairman. Greg Peters, COO, will join Sarandos as co-CEO. What do you make of the transition and how they handled it?
Well, I think it's gotten rather enthusiastic response from the investment community. So Netflix has been planning for this for a decade or so, they say. And 2.5 years ago, Ted Sarandos, who has long been the content chief at Netflix, was elevated to a new role of co-CEO. And his now co-CEO, Greg Peters, was elevated to a chief operating role officer, like 2.5 years ago. So these executives have been working together for 2.5 years. There doesn't appear to be any sort of conflict. So this transition translated to the street as being a really smooth transition from the company's co-founder to executives who've been working together, for 15 years and in this leadership role for the last 2.5. So it wasn't a particularly jarring transition. It seems, in fact, more effortless than some of their media peers here in Hollywood.
Don, I think maybe the question here is whether or not this is going to change the culture at all, because when it comes to Netflix's culture, it's really been a standout among Silicon Valley. A 125-page slide deck that describes its culture has been downloaded 17 million times. So it really just shows the interest in Netflix's culture. Are you expecting that to change at all?
So, that is a key question that we were examining. Like, as you know, Reed Hastings credits this company's very distinct culture. It has a performance culture. It invests a lot of autonomy in its executives, and Reed credits this sort of independence that it affords these high performing executives who come to the company with the company's success. But in interviews yesterday with Jessica Ehrlich during Netflix's earnings video, the new co-CEOs sought to assure the street that nothing will change, that they will attempt to adhere to the culture that Reed Hastings created and that they've worked within for well more than a decade. So
it's interesting.
They say no changes ahead, which perhaps explains how the market is reacting.
And no changes in terms of the co-CEO role, which you really don't see anyone else in that space do. Is that, obviously content is king, but is that part of the special sauce there at Netflix? Why does it work so well for them?
So it's really interesting. I mean, as you know, the history of co-CEOs is not always a stellar one. In the tech world, Oracle, for example, had co-CEOs not that long ago. Ditto for Salesforce.com, and it doesn't always work out. In this case, you have two executives with clearly delineated roles. You have Ted Sarandos, who is the architect of Netflix's drive into original content, and you have Greg Peters, who has more of a technical orientation, who is credited with helping Netflix rather quickly launch an ad-supported version of its service. He's behind the initiative. Netflix's initiative to get into games. So he has a much more technical orientation, and these two are seen as having complementary skills.
Don, from your coverage of Reed Hastings, everything you know about him, obviously extremely invested in Netflix, given that he's the co-founder, been with the company since the start, over 20 years. Now that he's chairman, I guess, how much do you really see him stepping aside versus his involvement with the company still?
Well, Reed Hastings in his message to investors was explicit in saying that he's not going anywhere. He will remain attentive to the company that he helped found, that he will be paying careful attention to the company's stock price, and will no doubt play a role in helping inform the company's direction for some time to come. He is handing over the reins of day-to-day operation to two trusted deputies who've already demonstrated their ability to lead the company.
Netflix has been mentioned in about a handful of names that could potentially acquire WWE, which makes sense when you compare the market cap is basically about 4 seasons of NFL rights. Could they be in that conversation, or will 2023 for Netflix be defined by what, do you think?
So I think Ted Sarandos has actually addressed the question about sports very directly, and I believe it was during a UBS conference fairly recently. So Ted is saying, look, I'm not going to say we'll never get into sports content. Indeed, Netflix has had some success with like dramatic programming built around sports, like its Formula One series was very successful and actually spurred interest in the racing sport. But Ted has said we don't need to have sports rights to continue to grow our business, at least not in the near term. And he's also said that those rights are expensive compared with the cost of other sorts of content that attract subscribers. So,
but I'm not talking about sports rights.
At least recently, Ted has signaled they're not in the sports, not in the bidding for sports rights.
But one, WWE is not a sport. I think it's more of an entertainment, and this isn't sports rights. This is an acquisition, really.
Yeah, we'll see. I don't want to speculate about deals that they haven't done. That gets me in trouble with my editors.
Certainly, we'll see what Netflix does. All right, Don Chmielewski, thank you so much for joining us.
Thank you.
All right, well, coming up, Amazon in hot water over safety issues at warehouses, but the fine is pretty paltry. We're going to have the details for you when we come back. Ongoing OSHA investigation into the working conditions in Amazon's warehouses has dinged the online retail giant with nearly $90,000 in fines over the last 2 months. Yahoo Finance's Allie Garfinkel joining us now with more on this story. Allie, $90,000, not that much when it's coming from Amazon.
No, Shauna, it's funny, I'm not used to talking about numbers as small as $90,000 on this show, so it was one of those things that I wanted to go back to the basics and figure out why. So first things first, the labor story at Amazon is clearly continuing to grow, and what we're seeing is that this week OSHA fined Amazon another $60,000 on top of the more than $20,000 that it fined Amazon back in December. Now, why? The answer is that these violations in particular are tied to ergonomic hazards, which means strains, back problems, that sort of thing. Now, to the numbers. These numbers seem underwhelming compared to Amazon, and what you're seeing here is that $60,000 from this month compared to Amazon Q3 2022 revenue and Amazon 2021 revenue. Shauna, we had a problem when we were making this graph because you literally could not see the 60K. The reasons why, right? And actually, as it turns out, that has nothing to do with Amazon. This is actually about how OSHA fines are structured because they can only legally be so high per federal law. Also, the way it works is that they're by violation, they're not by day, and they're not by severity. I had one expert actually say to me, Shauna, that it's less expensive to kill somebody than have a bunch of record-keeping violations. So in short, Amazon will probably keep getting fined is what I'm hearing, but also don't expect any jaw-dropping numbers coming out of OSHA here.
So then would you expect Amazon to do anything to change their behavior then?
That's a great question, Dave. One could argue it's the $90,000 question. And I think it's complicated. I think it's important to remember the significance of these investigations on a federal level. This ongoing investigation, Dave, is a collaboration between OSHA and the Justice Department. One expert told me that is incredibly unusual and represents a clear collaboration and a clear level of importance. So though these fees may not amount to much for Amazon, it's pretty clear the federal government is paying attention, and they can create a nuisance and ultimately perhaps public pressure. So bottom line, the Department of Labor has Amazon pretty squarely in its sights, and it's going to keep shooting.
All right,
We'll see.
All right, Ali Garfinkel, thanks so much for the latest on that. Americans might start seeing some relief when it comes to prices that they're paying this year. Luckily, some key items are seeing deflation. Brooke DePalma is here with the details. Brooke, we are so anxious for this. Where are we starting to see some improvement?
That's right. Some good news for consumers here. Smartphones among the top category that's seeing deflation. Of course, that's December 2022 as compared to December of 2021. But other categories, many that were popular during the pandemic, televisions, used cars and trucks, car rentals, video games, or video equipment rather. Of course, we are all working from home then, in addition to computers and smartphones. But this really a supply and demand issue that we saw in 2021, with many of these categories coming back in 2022. So with so many Americans at home, those rental car companies downsize their fleets. In addition to that, we saw that semiconductor chip shortage impacting new cars and more Americans going to used cars. In addition to that, bacon, lots of Americans flocking to bacon while at home. So that certainly surged in price. Of course, year over year, we saw that tick down. So it'll be interesting to see what comes out from Tyson and Kraft Heinz, Oscar Myers in upcoming earnings results. But it's not all good news, some bad news. Although we're seeing beef tick down in the consumer price index, that doesn't necessarily mean you're going to go to Shake Shack and you're going to get a burger for cheaper next time. They already put higher costs or higher menu prices rather in 2022, and so those higher menu prices are expected to stay.
But the bacon's gone down, so you just skip the eggs.
I wish I had a camera on you.
Skip the eggs, keep the bread, just have bacon.
Just bacon. Just a plate of bacon. That's up my alley, my friend. Okay, what items really surprised you here?
Well, that smartphone cost there. I feel like I spent so much money to get the new iPhone 14 Max there, but when
you got the 14.
I got the 14 Max there. But I spent quite a lot of money on it, and I was so curious. So I went out to the Bureau of Labor Statistics, economist Jonathan Church, and he said that they actually do the consumer price index with a reflection of quality change in mind. So basically, you're getting more bang for your buck for this new iPhone. So you're getting higher speed, you're getting more cameras, you're getting an increased screen size. And he said that it's typically a cycle effect. And while the Bureau of Labor Statistics is not in the business of forecasting, they said, quote, typically a new goods come in at a, quote, high price, and they see a decline over time until they reach a, quote unquote, mature age, at which point they begin to, or may begin to increase in price. So as Apple and Google and all these companies come out with more quality and bigger screen sizes and more cameras, we're going to continue to see maybe a lower price year over year.
What model you got, Shauna?
10. What do you have?
10. Shauna.
Yeah, I know. Frugal. What do you have?
I got 12.
Okay.
I just got this, to be fair. I just got this.
I'm jealous
okay?
of all the pictures, the quality of the pictures.
That's right. That's right. The quality is pretty good.
Maybe I'll upgrade soon.
Well, thank you. Enjoy the weekend.
You too.
All right, we'll be right back.
Our coverage of the World Economic Forum in Davos, Switzerland continues. Yahoo Finance's Julie Hyman and Brian Zazi spoke with the CEO of Anheuser-Busch about rising prices in the beverage industry. Let's take a listen.
One of the things that we saw happen in December in the United States, just to speak specifically there, beer prices went up and sales went down, at least for some of your competitors. And we also saw some industry data to support that. What did you all see?
I think that there was a lot of things in play at the end of the year, including the coldest weather that we have seen in many, many years. But definitely there was the impact of 2 price increases overlapping in December. So now in January, you are comping the first price increase of last year. Inflation was very high. It was the first time, I think, in many years that we had 2 price increases in 1 year to catch up with inflation. And we need to see now that's coming Super Bowl season. Let's see how things will play in January and February.
So are more price increases coming?
I think that most of the price for the industry, they were done in October, November last year. Now you are comping the year before price increase. So during this period of October, November, December, there were 2 price increases, one done in February and one in October. So there was a load for consumers to digest and retailers. And now you're getting into an easier comp because the last year January price increase is already into the books and you have only the regular price increase of October.
You mentioned Super Bowl. It is very, very close. Am I going to flip on the TV? Do I see the Budweiser Clydesdales? How are you showing up at this year's big game?
So there is a lot brewing there. The team is going to be releasing some of the TV commercials now, but you can expect Bud Light, Michelob Ultra, and some other of our brands showing up during the Super Bowl.
Do you still get the same bang for your buck marketing on TV as you did a decade ago during the Super Bowl?
It is a combination, so the mix of channels, they change, but Super Bowl is always Super Bowl. Everybody loves the game, we love sports, and our teams, they work creatively to reach consumers in digital, in physical experiences, and also using TV as part of the market mix.
Have you pulled back on your digital marketing at all?
Not really. I think that changing different channels, different ways of connecting with people, but digital has been growing over the years, and I think that continues to grow, but TV remains very important.
It was interesting there what he said, Dave, just about advertising during the Super Bowl. The amount of money that these brands pay makes your head spin. $7 million, record this year for just 30 seconds of airtime, but that is a company that's been doing it forever. When you take into account, I guess, why people do spend during that time, they must see it pay off. But certainly the brand exposure that you are getting compared to maybe some of the other events, but also just how much people have paid over time with Nike there, 46 minutes and 37 seconds leading the way. But certainly will be interesting to see what comes from this game and the brand advertising, not so much the game, but the brand and the advertising, the amount of money that's paid.
Well, there's just not many opportunities. In fact, there's only one opportunity to reach 100 million Americans in one 30-second bang. So I guess you can justify that. They've had an interesting year. I mean, you can keep in mind what happened with the World Cup, the massive amount of money that AB InBev spent to be the exclusive sponsor of the World Cup, only to have that pulled. No beer sales allowed. They did well with Bud Zero. There are no alcohol beer there. So that was an interesting play for them. Word is they still feel like they broke even there in terms of the exposure. But the Super Bowl, and now we have Miller Coors back in the game. We're not sure if it's going to be Miller Lite or Coors Light featured in the game. They're not going to tell us until actually you see that ad run. But you get so many exposures leading up to the game now with teasing it and with floating some digital ads and Instagram exposure. It seems to be a several week buildup for them. Back to the price increases. That's what's been really dramatic in that space. You're talking about beer outpaced wine by 2, spirits 5x, and even outpaced grocery increases 3x in terms of the price increases the last 4 weeks of the year, and that demand came right down with it. So that's one of those stories when you look at the general economy. They clearly saw an inflection point in which they cannot continue to raise prices. People will simply move on and find something else to drink, and they did late last year.
And they did, yeah. We'll get results from Anheuser-Busch next month, and will be very interesting to see because analysts have become a little bit cold when it does come to their outlooks on Anheuser-Busch right now. They did get a downgrade here not too long ago from UBS downgrading to sell from neutral, lowering its price target there because of the fact that we are seeing beer sales slip so much or really start to level out. You mentioned higher prices. Clearly, so many consumer-facing names have been forced to raise prices as they have tried to put less and less pressure on their margins here. I think we might have reached that inflection point that you were talking about just in terms of the fact that we are in a downturn right now. More and more layoffs, it seems like, by the day. People are going to start adjusting how they are spending, and these consumer-facing brands will probably have a tough couple of quarters as a result.
And it's January, and dry January has taken off. Morning Consult says 15% of U.S. adults are at least trying dry January. That's not to say they'll complete it, but bars, restaurants are saying it's taking a serious dent out of their bottom line. Some say between 10 and 15% hit now they're seeing in dry January, and that's why some of these companies are getting in on the act, launching their own non-alcoholic beers and non-alcoholic cocktails and the like.
Are you getting in on dry January? Did you?
I don't think I made it 4 hours.
Yeah.
5 hours, maybe.
I don't think I made it a day either. No.
I have no
never
interest.
done it. I've never done it, but I do applaud everyone out there who's doing it. Because
I do too.
It's a healthier choice.
Not for me, though.
It's not for me, at least right now. All right, well, coming up, the CEO of the Bill and Melinda Gates Foundation joining us from Davos to explain why he's facing criticism about the organization's power and defending the philanthropy's influence on global health. Don't go anywhere. Our coverage of the World Economic Forum continues. Let's head over to Julie Hyman in Davos, Switzerland.
Thanks, Shauna and Dave. Well, one of the things that we try to examine at Davos is the disconnect between the goals that people talk about at Davos and the actual action that ends up happening. One of the people who's well poised to talk about that is Mark Sussman, the head of the Bill and Melinda Gates Foundation. And I asked him about that, whether things get done after Davos.
I think you've hit the nail on the head in terms of today's Davos, where there is a huge amount of commitment in principle. The theme of Davos is around new forms of cooperation, collaboration, rebuilding a world of prosperity, focusing on issues like gender equality and women's economic empowerment or climate. But when it comes to the needs of the poorest and most vulnerable, which is, the 1/3 of the world heading into recession, many across countries across Africa, Asia, Latin America, we're actually not seeing a lot of concrete action and discussion. And so one of my roles here this week is to really try both to highlight what we at the foundation are doing, and today we're actually announcing a record budget of $8.3 billion for this year to try and tackle these issues, because we're saying the urgency is now, and to try and prove some of the models, saying there are actually things we can invest in and scale, such as in the area of gender equality, that can make a transformative difference, but it requires action, not just rhetoric.
Well, so you guys have a lot of resources, as you just alluded to, but you still can't do it alone. You need cooperation from other organizations, both in the private and public sector. And you allude to this in your latest letter, where you talk about shockingly little money has been spent to meet the needs of farmers in low-income countries, even by donor nations that have made public commitments to do so. So when you come to something like this, and there are representatives from those nations, what are the sort of levers that you have? How do you try to convince these other entities to fulfill those commitments?
Yes, well, agriculture is a great example, because if you think about climate change, and there are multiple panels about climate change here this week, but they're nearly all focused on energy and climate mitigation. That is critical. The carbon transition is fundamentally important, and we don't want to take anything away from that. But the people who are suffering most from climate change right now are poor farmers in developing countries, largely in Central Africa, bits of Asia. If you think about the devastating Pakistani floods last year that put 1/3 of the country underwater, or the devastating drought in the Horn of Africa. Yes, these are areas that have had weather problems before, but never of this scale. They are clearly climate change induced. And there has been an official commitment by the world to double their resources in what's called climate adaptation. How do you help these poor farmers adapt? Can you create new practices of better water use, of develop new drought and flood resilient crops and livestock? We have made a significant investment. I actually announced a $1.4 billion investment at COP around it, which we were very concrete about. Here's what it's doing about supporting women farmers here. Here's what we're doing about supporting research and development in crops. And what we try to do is show and almost shine a mirror back in people, saying, you've made a commitment. And don't say there aren't shovel-ready projects to put resources into, because we can give you a list of a dozen right now that you could and should be doing. And then we try and encourage those partnerships. So that's what's underway right now. It's been a struggle, because currently it's only a tiny proportion of the total resources that go on climate go on these kinds of issues.
One of the other big topics here at Davos, besides cooperation, is the economic backdrop for the globe, which is a little bit sobering right now. We know things are going to be slowing. Whether we get a recession in the U.S. and beyond is still an open question. What effect does that have on the most vulnerable? What's the process of the sort of ripple effect from developed economy slowdowns and recessions on the folks that you serve?
Yeah, huge. And, COVID has been devastating for everybody in every country. But in many ways, across parts of Africa, Asia, Latin America, the non-COVID effects of the COVID crisis, the economic effects, are even more profound. Because what you've had is countries which never had the kind of resources that the United States or Europe had, have exhausted their fiscal power in response to COVID, are now facing a debt crisis, raising interest rates, other challenges which leave them with no resources to actually invest in their own people. You're seeing countries paying many more in debt reservice payments than they are in the health and education of their own people. And that's not fully understood or internalized in most of the world. And that comes on the back of 2 decades of unprecedented progress. The other thing that people don't realize is how much the world got better in the first 2 decades of the 21st century. We had literally hundreds of millions of people moving out of extreme poverty. We reduced preventable child mortality from over 10 million deaths a year to fewer than 5 million. Those trends were continuing, and they have stalled and stopped and to some degree reversed. And so that's the message that I'm bringing, is saying we need to address that, take action. And again, we can bend that curve. It is very positive to actually, or very possible to have significant improvements very quickly if we get the resources in action now.
Finally, I want to ask a little bit about the operations of the foundation, which obviously does a lot of work, as you've been describing. I'm curious what the involvement of Bill and Melinda Gates is at this point. Bill Gates sometimes comes to Davos. He is not here this year, but is it sort of something they've put all this energy into, and now it's its own thing and runs its own? Talk to me a little bit
Absolutely
about that.
The reverse. So Bill and Melinda have both been hugely engaged over the last year. In fact, we just finished. The reason I'm able to announce our new budget today is we had our board, and we over the last year we created a new board of trustees, a great set of people working with Bill and Melinda as co-chairs to approve it. And Bill and Melinda have worked very closely with me, with our teams, literally approving every single decision. I sat down with them, and we were going over line item by line item every bit of the budget we were approving. They've been engaging in all our internal and external strategies. Melinda was recently in India and in Senegal and Rwanda for the foundation. Bill will be doing multiple trips to Europe and Africa later this year. So no, they are more engaged than ever, fully committed to everything we do at the foundation. And frankly, I think we see the need of what we do is sadly more important than ever at a time that others are not yet stepping up, but we hope that will change.
So really interesting to hear that Bill and Melinda Gates are still very involved and hands-on with their namesake foundation. Back to you guys in the studio.
Okay, thank you so much, Julie. A wonderful week for those two, huh? Sazi
They
and
did
Julie
a great job. A lot of
awesome
interviews. They
job.
packed a heck of a lot in there.
Broke a lot of news as well. Looked like they had some fun on the side in addition. All right, next week I'm watching earnings from some big tech companies. On Tuesday, we get second quarter earnings from Microsoft. Wednesday, we get Q4 reports from Tesla and IBM. And on Thursday, Intel reports its fourth quarter results. So let's go through them one at a time and start with Microsoft. What jumps out to you?
Yeah, Dave, it's going to be an interesting quarter here for Microsoft. We know the company just announced 10,000 job cuts. I'm sure the street will want to hear a little bit more from Satya Nadella just in terms of those cuts, what he thinks that's going to mean for the company here going forward. Revenue growth is expected to be the slowest pace that we have seen in about 6 years. Also, the company got its first sell rating in more than 3 years this week. So the street kind of taking a second look at Microsoft over the past year. We're looking at a one-year chart right now. The stock off just about 20%. So Microsoft, I think a lot of the emphasis is going to be on the earnings call and what we hear from executives there.
And you know, my all eyes are on ChatGPT. Interesting to have a conversation earlier about this in terms of, you saw Larry Page and Sergey Brin come back, according to the New York Times, because of the threat that ChatGPT poses to the AI business over there at Alphabet. And we still haven't seen how they're going to monetize ChatGPT, but the theory is it poses a real threat to Google's search business. Many don't buy that because they don't think there's a realistic challenge from Bing. I happen to agree with that. I think the monetization is going to come elsewhere, and those practical uses, applications are quite frankly endless. All right, to Tesla.
Tesla, I think a lot of it's going to be on the call as well. We know that delivery number missed estimates when it coming into fourth quarter. That was a huge disappointment for the street. The price cuts, I think we're going to want to hear a lot more about that, what it has done for demand. It's only been, about a week so far, but what they think it could do for demand going forward. And then, of course, on the negative side, the pressure might be on margins. But again, Tesla's still off about 60% in the last year.
And margins, we won't really know. They're probably not going to tell us, and it's more of a Q1 story for the next report. Now, also on Tesla, Elon Musk did take the stand today in California. This is all related to that 2018 tweet claiming that he had lined up the financing to take Tesla private. And Alexis Keenan reporting that he did say this on the stand: difficult to say that the stock stock prices linked to the tweet. Asked whether he's aware that Tesla's price stock sometimes goes up or down following his posts, Musk rejected the idea that his tweets could be directly correlated to the stock's behavior. Really? I think he's well aware of the impact his tweets have on stocks' behavior, not just his own. Look at what he's done with Dogecoin and others.
Yeah, I think so too. And will be interesting, more of the headlines that come out from that today. Also, Intel is going to be an important one to watch. We talk about the slowdown that we have certainly seen in the chip sector. That has been reflected in shares off nearly 30% in the last 6 months. Some of that contraction, though, in industry, I think, is expected to pressure the top line here for Intel. Bank of America is saying that their estimates, they think it's going to drop about 9%, well below the consensus of a 3% drop. Weaker performance here being flagged by management, but I don't know how much of that has already been priced into the stock. Certainly, some of that rebound might be further out than we had anticipated. Maybe second half of 2023 is a safer bet.
Pat Gelsinger in Davos telling CNN where the technology supply chains are and where semiconductors are built is the most important question for the next 5 decades. He said it's more important than even oil reserves for the future. So a massive statement on the future for the space from Pat Gelsinger. All right, coming up, a shortened work week. A new study reveals some of the biggest benefits of a 4-day work week. That's next.
Working 9 to 5, Monday through Friday, with some exceptions, has been a hallmark of working life since the Fair Labor Standards Act instituted the 40-hour work week in 1938. But the case for the 4-day work week or 32-hour work week has been gaining some traction now for a few years. Well, a panel of experts at the World Economic Forum in Davos this week saying that recent studies show that reducing the work week by a day brings increases in productivity and efficiency and also revenue. One such study from 4-day work week Global ran a trial last year, moving 33 companies and just over 900 employees to a 32-hour work week. 99% of those employees wanted to continue that schedule. No surprise there. On a scale of 1 to 10, with 10 being very positive, the companies rated the overall experience at a 9. I want to know who didn't give it a 10, and rated its effect on productivity at 7.7. Those numbers, Dave, I'm sold. We should be doing the 4-day work week.
Yes, we absolutely should. Unfortunately, the markets are open 5 days a week.
For now.
And so most of our audience does not apply. But I think those in particular industries that doesn't require a 5-day work week really should take a look at that productivity factor, even aside from how happy your employees are. I will say I live in a town that is probably 75% Wall Street based, and none of them go to work on Fridays. The parking lot of the train station is empty, yes, but they do say their productivity goes up on that day. They actually work more on Fridays because they're not spending all that time commuting. So I think it's something more employers should certainly take a look at. I'm game for hybrid Fridays.
I'm in it. We just need to get everyone on board. But I like the results of this study. All right, well, for that, we are going to leave you here for the weekend. Thanks so much for tuning in. We'll see you right back here again next week. Have a great weekend.